Welcome back. Tomorrow we're expecting the CPI Consumer Price Index number to be released. I thought it might be helpful to take a quick snapshot of where we sit in terms of the markets ahead of time, given the very volatile nature of the bond market, especially as of late. Just to recap, if you recall, the Federal Reserve met raising interest rates by quarter points. And then we had the non-farm payroll numbers, the jobs numbers last Friday, which really caused the 1 year, or I should say the 1 month, 1 year as well, but really the 1 month T-bill, the yields to skyrocket. Right now we see a 1 month T-bill pays a 5.56% interest rates. That's higher than the 2 month at a 5.16. That's higher than the 3 month at a 5.29. Much higher than the 10-year at a 3.53. Now, really, the entire market kind of experienced a pivot after the jobs numbers last week, in the sense that the Federal Reserve met. We had a soft GDP number prior to that, soft durable goods order number prior to that, but then the jobs number came out and it was better than expected in terms of the unemployment rate, as well as the overall non-farm payroll number. And that led the market to believe that higher interest rates could be in our future. And that's the reason, I think, why we saw this skyrocketing yield on the 1 month T-bill. The 1 month T-bill is the most volatile because it's the shortest maturity. Now, the idea is where the 1 month T-bill goes, that the 1 year will follow. And again, the short-term maturities, especially like the 1 month T-bill and the 1 year bond, forecast the immediate future, whereas the longer-term 10-year gives us a forecast as far as the long-term future. The inverted bond market state that we've seen for quite a while now, since about June of last year, indicates that the bond market and everybody participating in the bond market sees higher interest rates in the immediate future and lower interest rates in the long-term future, meaning more bearish over the long term. Now, this is the 1 month change in bonds. This just simply demonstrates how much of a surge we've seen in the 1 month T-bill, 30% up in the yield in the past 30 days. 10-year up only 4%, the 3 years basically flat. So really, all the movement lately in the bond market has been this T-bill. This month in bonds, the black dotted line shows us again this 1 month T-bill. We were at a 3.36% yield on April 21st. All of a sudden, a couple weeks later, that 3.36 is now 5.56. That is a huge surge. Notice that the rest of the market is really kind of holding steady. We have the 1 year, and this is really kind of enforces what we were saying. The 1 month is creeping higher. We had the 1 month. This is the purple dotted line here, 459. That was on May the 4th. 459 is now 481. So that's about 22 basis points right there on the 1 year. As the 1 month goes higher, the 1 year tends to follow a little bit more slowly. Now, we look at the 10-1 spread, and we see here this is the 10-year is a red line. The blue line is, the 10-year is a blue line. The 1 year is a red line. The histogram bars here show us currently we're sitting at an inverted level of almost or right around 1.3%, or 130 basis points, which is huge. This is almost the largest amount of inversion that we've seen this entire time, going back to the beginning of the inversion last June. And then finally we see here the black line, again, the 1 month T-bill skyrocketing higher. The gray histogram bars in the background, that's the S&P 500. Now the S&P 500, it's been strong, weak, basically in a trading range. I think the stock market's really kind of caught in a point of crosswinds. It doesn't know whether to go up or down. Stock investors there's a lot more, I think, going on in the stock market, in the sense that there's different sectors. There's a price of oil and commodities, and there's a big push and pull. And I think that's why the stock market's kind of locked in this trading range. But I think also the stock market might be waiting to take a cue from the bond market. And the bond market seems to be a little bit, sending mixed messages as well. The 10-year yield is much lower than the 1 year, and especially the 1 month. Now, speaking of the stock market, we've covered this recently, so we won't, go into too much detail, but we have different indices within the stock market. The Dow Jones Industrial Average are the 30 largest stocks like Home Depot and Coca-Cola. The S&P 500 are 500 of the largest companies out there by market capitalization. The NASDAQ is heavily weighted towards technology. The Russell 2000 is a small cap index. Now, the reason why we're talking about this is because typically when there is a consensus in the market, all stocks tend to move together. When there's low interest rates and good economic conditions, all stocks like to go up. But when there's a divergence, or when we have a consensus and that begins to diverge, when one index begins to drift away from another, that could represent the beginning of a change of the overall trend. Not all stocks are going to turn at the same time. Not all indices will turn at the same time. One will lead the other. So, for example, we have the yellow line here. That's the Russell 2000. The red line is the Dow. The purple line is the S&P 500. The green line is the NASDAQ. Now, the black histogram bar in the background shows us the level of divergence or spread between the different markets. So, for example, we're talking late March here, the spread was very, very low. And that showed us that all the indices were moving together. That sharp move down. All stocks went down at the same time. Well, stocks began to recover, and the Russell 2000, the yellow line, really, the small cap stocks really could not find any kind of bid out there. They didn't go up, and it seems like they've actually gone down, since then. The the S&P, the Dow, the NASDAQ have all gone up, but we're beginning to see more of a divergence. Take a look at how high this divergence is. This is the highest high we've seen. This is what I wanted to, bring this up. This is the highest spread we've seen since at least October of last year. There's more of a divergence between the different indices in the stock markets. So when we look at our, investment accounts or 401ks, whatever, it really does depend what stocks we're involved in. Some stocks are doing very well. Some stocks are doing very, very poorly. So it really is, as they say, a stock picker's market. And that means there's not a consensus. It means there's many, many different currents flowing through the market right now. Now compare this. This is 2001. The blue line is the Dow. Now, just use the Dow as a barometer of the overall trend. The black histogram bar area chart in the background, that's the spread. Notice we had first off, we had very strong markets, late part of the year 2000. The Dow was up near 11,300. The spread was relatively low. But as the Dow was caught in this trading range over here, really didn't make a move, we see the spread start to widen. That means internally, certain stocks start to fall faster than others. And that's before the market really took a downturn. Obviously, September 11th was a big catalyst for that move later on. But even before that, we saw a big spillover in March of 01. And that was the result of certain stocks leading others. And eventually, when they all went down, the spread narrowed because they all went down together. Now, we had a recovery. All the stocks tend to move up, and then all of a sudden the spread really widened. Take a look to see how far the spread was before the stock market even went down in 2002. 2008, same situation. 2007, May, stock market's very strong. All of a sudden, the spread widens. The spread widened. The Dow was still at the 14,000 level. Then all the stocks decide to move down together. So the spread widening really is a warning sign that, hey, some of the stocks are starting to fall out of bed faster than the others. 2019, the Dow was chugging along up near 27,000. All of a sudden, the spread started to widen while the stock market was still relatively strong. Take a look at the difference here. So putting this all in perspective now we have the four different lines to give us more clarity on what's going on here. The spread was already kind of wide because the Russell just really was not able to find any kind of rally out there. But especially as of late, and we're talking specifically between what happened from mid-April to present date, the spread has widened even further. The red line, the Dow Jones Industrial Average, and again, that's the big companies, Home Depot, Coca-Cola, Boeing, Disney, things of that nature. Those big stocks look like they're starting to fail faster than the S&P 500 and even faster than the NASDAQ. Seems that the NASDAQ, surprisingly enough, is actually more resilient than the Dow stocks are. Now, of course, there's only 30 stocks in the Dow, so every point of every Dow component does affect the index to a greater extent. But nevertheless, we see a big divergence developing here within the different equity markets. So that's, I think, something that we should certainly be aware of. Again, tomorrow is CPI, Consumer Price Index. The reason why that's very important, it's our first big economic number after last week's jobs numbers. Last week, jobs numbers sent a huge rally in the 1-month T-bill. I want to see if that 1-month T-bill rally continues or if maybe it softens. If it softens, maybe the 1 year will come down as well, and that certainly will be a very interesting development. But we're really going to, let the market give us a clue, especially with the movement of the 1-month T-bill. So we'll revisit these numbers and many others in the time to come. We hope this has been helpful. We look forward to seeing you back soon.